Hi, and welcome students. This is Accounting 1100, Financial Accounting 1. And in this video, we're going to be going over practice problems for Learning Module 3. I hope everyone is having a great day so far. And for me today, it's very cloudy and gloomy and gray. But we're going to power through and get this video recorded for you guys so that you can use it to practice your problems for Learning Module 3. And hopefully it will help you on any homework problems you may be stumped on as well. So Learning Module 3, we went over the adjusting process in accounting, and that covered all the adjusting entries you will do before closing out an accounting period. So let's get started. So as you can see here, our first problem is an adjustment entry for accrued revenues, okay? So the instructions say at the end of the current year, $36,920 of fees have been earned, but not yet billed to the clients. There are going to be some situations to where you may not have billed the client yet. So you may have an agreement where you provide services for a client and bill them every 30 days. But if the agreement began on the 15th of every month, then you would only bill them on the 15th of every month, which means halfway through every month, you're going to close out an accounting period. And so you're going to have like half the month's worth of services that you've provided, but not yet billed, but you still need to capture that revenue. It's very important that we always capture the revenue in the time period that they occurred so that we're getting a true capture of revenues and expenses. So it wants us to journalize this adjusting entry to record the accrued fees. And it says to refer to the chart of accounts for the exact wording on the account titles. So let's go ahead and let's open up all the tabs so we can look at everything. So our chart of accounts is right here. All right. So we have our assets, our liabilities, our equity, our revenue, and our expenses. And now we have our journal that we're going to use to record our journal entry. So right off the bat, we are recording for revenue that we've earned, but not billed yet. So we've earned it, not billed it. The two accounts we're going to use for this is going to be fees earned and accounts receivable. Why? We've earned the revenue because we provided the service. We've earned it. So we can record the revenue. So that's where we're going to hit fees earned, but we've not billed it yet. So the customer has not been able to pay us yet. So we're going to hit accounts receivable, money that we will receive once we bill the customer. So in the journal entry, you always start out by entering your date. Okay, so it tells us here that it's for the end of the year. So we're going to use the date December 31st. Now, again, we always start by doing our debit entry first. So let's go up here to our chart of accounts, and we're going to record to our accounts receivable because it's an asset, and assets are always recorded with a debit. Revenue are always recorded with a credit. So we'll start with accounts receivable. So we'll do my little trick and we'll highlight, copy, and paste. And the amount was $36,920. So we'll go ahead and enter that amount in. Okay, there's our debit entry. Now we'll come over here to our fees earned. And we look over here to the side where it shows our accounting equation. All right, so we've increased our assets and we've increased our equity. So our accounting equation is balanced. So let's go ahead and check our work. Everything looks good. So this is how we record accrued revenues. Revenue that we've accrued, but not yet billed. So we're going to hit our revenue account and we're going to hit accounts receivable. Okay, let's move on to our next problem. Now we're going to look at one for an adjustment entry for an accrued expense. Okay, this is an expense that you've incurred, but you're not in a position to pay yet. So many situations could happen to where this may occur. The example in this problem is Blue Ocean Realty Company pays weekly salaries of $14,820 for a 6-day work week. But however, the accounting period is going to end on a Thursday. So you have a situation where your accounting period is actually ending before your pay period does. So you have at least 4 days of labor expenses that you have accrued and you need to record on your books. Because again, it's very important to get a true snapshot of all your revenue that you've earned and all your expenses that you've incurred in the time period they occurred. Okay, so in this situation, you have 4 days of labor expenses you need to capture and record on the books. So the first thing we're going to do is we're going to open up all of our tabs. And here's our chart of accounts. And here's our journal. Okay, so we got to do a little bit of math first. So it tells us that a pay week averages $14,820 for a 6-day work week. So the first thing we're going to do is we're going to take this $14,820 and divide it by 6. And that gives us $2,470. Now it tells us down here, assume that the accounting period ends on Thursday. All right, well, Monday, Tuesday, Wednesday, Thursday, that's 4 days. So we're going to take that $2,470 and multiply that by 4. So the amount of labor expenses that we're going to capture and record on the books for this accounting period is $9,880. So now that we've completed the math, now let's figure out what accounts we are going to use. All right, so I've already told you it's salaries. So we're going to come over here and find our salary expense. Expenses are always recorded with a debit. So that's going to be your debit entry because we're capturing our expenses. And this is for salaries. So we're going to hit salary expense. Expenses are always recorded with a debit. So we know that's what we're going to debit. Now let's figure out what we're going to credit. All right, it's money that we will owe, but we're not going to pay yet because payday is not till Saturday. So it's something that we have to pay, which means it's a payable. So we're going to come over here to liabilities and we're going to look for salaries payable. Now, salaries payable is a liability. Liabilities are always recorded with a credit. So now we know what we're going to debit and we know what we're going to credit. So let's go ahead and get everything set up and ready to go. So it tells us that the period ends on July 31st. So that is going to be the date that we will use is July 31st. We're going to hit our salary expense account and it's for $9,880 because that's 4 days worth of salaries. The next one is we're going to credit our payable, our salary payable. All right, so if we look here, we hit expense, expenses reduce equity, and we hit a liability, and we're setting up the payable. So we are creating the liability. And so we've increased our liabilities, showing that we have created a debt that we will pay on payday. So let's go ahead and check our work. Okay. All right. Now we're going into the deferrals. So we just did 2 examples of accruals. Now let's go into the deferrals. So we're going to do an adjusting entry for unearned revenue. So let's go ahead and open up all of our tabs and let's take a look at what we got. Now, unearned revenue is exactly what it sounds like. It's revenue we haven't earned yet. So why would we put this on the books? Well, sometimes you as a company are going to get paid for services before you provide the service. So when you get paid without having provided the service, you have technically not earned that revenue. Therefore, it is going to be considered a liability because it is money you may potentially owe back if you fail to provide the service. So that's why it's considered a liability. Okay. So let's look at this situation. So on August 1st, Newhouse received $25,320 for rent of land for 12 months. Okay, so they got paid in advance. They have not earned that revenue yet. they got paid up front. Okay, so now it's wanting us to journalize an adjusting entry required for unearned rent on December 31st. So on August 1st, they paid us for 12 months. It is now December 31st, and we have to record the revenue we have earned since August 1st. So the first thing we're going to do is we're going to take that $25,320 and we're going to divide it by 12. That way we know the monthly rent rate. Okay. So $2,110 is our monthly rent rate. Now, the next step we're going to do is we're going to determine how many months of rent have we earned since August. So we have August, September, October, November, December. That's 5 months. So we're going to take that monthly rent rate and we're going to divide that by, multiply that by 5. And it's going to give us a value of $10,550. All right, so now we know the amount we're going to record. Now let's figure out what accounts we're going to debit and credit. So let's go down to our chart of accounts. So right now it's told us unearned revenue, okay? Because that's what it's told us up here, that we're going to be doing an adjustment entry for unearned revenue, okay? It's specifically for rent, okay? So let's go down here. And we see a liability for unearned rent. Now, it's a liability count. So when we initially recorded this payment in August, okay, we credited unearned rent because it's a liability. It's just like setting up a payable. You initially credit, okay? That's how you increase the liability. We're actually decreasing this liability because we're now saying we've earned 5 months. So we need to actually decrease this liability. So we're going to actually debit unearned rent. Put in our amount that we calculated. Now let's figure out what we're going to credit. If it's no longer considered unearned rent, it's the opposite of unearned rent would be earned rent, which would be rent revenue. So now they're saying as 5 months have passed, 5 months of the unearned rent have expired, and it now can actually be recorded as rent revenue because we've actually provided the service for those 5 months. So we can now take it out of unearned revenue and record it as actual revenue. So we're going to come up here and we're going to find rent revenue. Now revenue is recorded with a credit. So that's why this is our credit entry is rent revenue. All right, now this all happened on December 31st, so let's not forget our date. All right, so here you see we reduced that liability because we're taking it out of unearned. Okay, we're taking out of unearned because we're saying we've earned 5 months. Okay, when we received the payment back August 1st, we recorded all 12 months as unearned rent. So we debited cash because we got money, so we're going to increase our cash. So we did a debit entry to cash and we did a credit to unearned rent for the full amount. Well, now that was August 1st. Now it's December 31st. So we got to figure out how much of the 5 months are we going to record as revenue now. We're going to take it out of unearned rent and put it to rent revenue. So let's just real quick, I wanted to click on that to show the answer, how the math is done. Okay, so we took the full amount we received August 1st, which is $25,320. We divided that by 12 months to get the monthly rate. We figured that we had earned about 5 months, August through December. So we're going to multiply that monthly rate by 5, and that gave us the $10,550 that we're now going to record as rent revenue. So we take it out of unearned rent and we put it to rent revenue. All right, let's do the next one. All right, there's another example of unearned revenue. So again, August 1st, New House Company received $44,770 for the rent of land for 12 months. So it wants us to journalize the adjusting entry required for unearned rent on December 31st. So again, you're going to take that $44,770 and divide it by 12. All right. And then we already know from the previous example that it's going to be 5 months. So then you take that amount and you multiply it by 5. Okay. And that's going to give us the amounts that we're going to record. Now we got to figure out what accounts we're going to hit. Now, again, we're taking it from August 1st to December 31st. We're going to take it out of unearned revenue and put it to revenue. So to take it out of unearned revenue, we're going to debit the unearned rent because it's a liability. So debiting a liability is going to reduce it. And then that's what we want to do. We want to reduce that liability. All right. And now we're going to actually be able to record it as actual rent revenue. So let's go ahead and check our work. And again, here's that calculation to show you what it looks like and how we came up with that amount. Took the $44,770, divide it by 12 to get the monthly rate, multiply the number of months that you've now earned the rent, which we calculated was 5 months, and that gives you the amount that you can now record as rent revenue. Okay, so this is another example of accrued revenues. All right, journalize the adjusting entry to record the accrued fees. So at the end of the current year, $12,710 of fees have been earned but not billed to the clients. So again, we're going to hit accounts receivable for the amount that we have earned but not yet billed. And we're going to go ahead and hit fees earned because we've earned them but not yet billed the customer. So if you've earned the fees, you can record it to revenue. So again, at the end of the accounting period, there may be revenue that's been earned but not yet been recorded. So it's, in such cases, you will increase revenue because you've earned it. But you're going to post it to accounts receivable because you will be paid later. So it's money you're going to receive. Okay, another example of an accrued expense. So again, this is another salary. All right, this time it is a 5-day work week. And we're going to assume that the accounting period ends on a Tuesday. So again, we're going to take that 12,250 and divide it by 5 because it says it's a 5-day work week. And the accounting period ends on a Tuesday. So that means Monday, Tuesday, a 2-day work week that we're going to capture. So then we're going to take that amount and then multiply it by 2. So the answer is going to be $4,900. That's going to be the amount. Now, these are expenses that we've incurred. Okay, so we've incurred them. So we're looking at salary expense is going to be our debit, and salary payable is going to be our credit. All right, so again, here's that equation so you can see how it was calculated and how that number came up. So we took the 12,250, divided it by 5 because it was a 5-day work week. Then we multiplied it by 2 because that was the number of days left in the accounting period, because the accounting period ended on a Tuesday. All right, so we're going to have to capture those 2 days worth of salary expenses to put on the books before we can close that accounting period. And we offset it with a payable because when it is on payday, which is Friday, we'll take it out of accounts payable and actually reduce cash when we actually process payroll. Okay, so let's do one for prepaid expense. All right, so let's go ahead and open up all of our charts of our tabs. Okay, so the prepaid insurance account had a beginning balance of $3,710 and was debited $6,035 of premiums paid during the year. Journalize the adjusting entry required at the end of the year, assuming the amount of unexpired insurance related to future periods is $3,005. Okay. So let's go ahead and go down here and let's look at this. So this took some kind of figuring out. All right. So we had prepaid insurance with a beginning balance of $3,710. Okay. It was debited $6,035 for premiums paid during the year. So prepaid insurance is an asset, first of all. It's an asset. So debits increase it. Okay, so if we already had a balance of $3,710 and it was debited $6,035 with premiums during the year, we will be adding those two amounts together. Okay, because that was our beginning balance, and then that was additional debits to that account. So you're going to start out by adding these two amounts together. All right. All right. Now, it says to journalize the adjusting entry required at the end of the year, assuming the amount of unexpired insurance related to future periods is $3,005. So there's what they're saying here is you started out with $3,710. You had additional premiums paid equaling $6,035, but your ending balance at the end of the year was $3,005. So how much are you going to journalize as your adjusting entry to show how much of the insurance premiums had expired, meaning it went from being a prepaid expense to an actual expense. So we started out by adding these two numbers together because that was our beginning balance and that was additional debits to the prepaid expense account. So we started adding these together. Now, this is the amount that is left as unexpired insurance, meaning this should be your ending balance for your prepaid. So we're going to now subtract this $3,005 out. Okay. So that's going to leave us with $6,740. That's the amount that you're going to use to record your adjusting entry. So let's go down here and look at it. Okay. So again, what we're doing is we're recording an adjusting entry, taking out, reducing the prepaid expense and recording it to the actual expense because it is expired. When it says it has expired, it means that it's no longer considered prepaid. It's now an actual expense. So the time has passed. So as each month passes, you take it out of prepaid and you actually record it to the expense account that it belongs to. So again, prepaid is an asset. So to reduce that asset, we're going to credit prepaid insurance, and we're going to record it to the expense account. And expense accounts are always recorded with a debit. So we're going to debit insurance expense. And the amount we're going to enter is $6,740. And if you look down here, this is how they came up with that amount. Again, we added the beginning balance to the additional premiums paid, less the ending balance to get the amount that was actually had expired throughout the year, which was $6,740 worth of prepaid insurance went expired from being prepaid to being just actual expense. Okay, we're just going to skip on because that's the same example. Now let's do an adjusting entry for depreciation. Okay. Again, depreciation is your fixed assets other than land. They depreciate in value over time, kind of like we talked about your car, how it depreciates in value over time. The equipment you use to generate revenue, it's also going to depreciate over time. So you have to record that depreciation on your books because as it depreciates, you need to be reducing the value of that asset on your books as well. So that's also an adjusting entry. So let's go ahead and open up all these tabs. Let's take a look at everything. The estimated amount of depreciation of equipment for the current year is $7,440. Journalize the adjusting entry to record the depreciation. Okay, so it says refer to the chart of accounts. So let's go over here to our chart of accounts. Okay. So right off the bat, we see an entry under assets that says accumulative depreciation equipment. This is what we call a contra asset account. It's actually used to reduce the value of the asset account for equipment. Okay. And then we come over here, we see another account with the word depreciation in it, and it's called depreciation expense. So when you actually reduce the value of the equipment, okay, by recording it to the accumulative depreciation contra asset, your offset is going to be an expense account because you're going to show you're expensing out that depreciation. Okay. So let's get down here and get ready to do our journal entry. So this is an entry we're going to do at the end of the year because it's an adjusting entry for all the depreciation that has accumulated throughout the year. And it's not uncommon for companies to record depreciation once a year at the end of the year. That's not uncommon. Most companies do not do it monthly nor quarterly. Most companies do depreciation annually. All right, so what's going to be our debit entry? again, we're going to go to our expense account. Expenses are always recorded with a debit. So there we go. That tells us what's going to be our debit account is depreciation expense. The amount was $7,440. So that's the amount we're going to record. Now, this is a contra asset account. So we're crediting it. I know you're thinking, well, under assets, if it's under assets, I should be recording it as a debit because assets are recorded with debits. No, because we're using this as a contra asset to reduce the value of this asset, equipment. So we're going to actually be recording it as a credit. So if you look here, the expense, no surprise, it does reduce our equity, but your cumulative depreciation also reduces the asset value. So we check our work. Everything's got green checks. Everything looks good. All right, so let's talk about the effect of omitting adjustments, okay? So for the year ending August 31st, Mammalia Medical Company mistakenly omitted adjusting entries for depreciation, fees earned but not billed, and accrued wages. Indicate the effect of the errors on revenues, expenses, and net income for the year. All right. So let's just go ahead, open this up and look at it. So overall, if we look here for A, revenues. All right, so the of 1, 2, and 3, the only one that affects revenue is the fees earned that were not billed. Okay, so fees earned not billed, if you were omitted to record that adjusting entry, you would definitely understate your revenue because you're not capturing that revenue you've earned in that time period. So your revenue is going to be understated. Okay. And if your revenue is understated, your net income is also going to be understated as well. So let's go ahead and jump to B. All right, expenses. So we have 1 and 3, excuse me, depreciation and accrued wages. Both of these are going to affect your expenses. If you don't record your depreciation, you're understating your expenses because you're supposed to record your depreciation against a depreciation expense. If you fail to record your accrued wages, and then your wage expense is going to be understated as well. So if you look here, both of these amounts, okay, added together, and that's the amount of expenses that are going to be understated, 10,300. So A, number 2, affects revenues, and it understates the revenue by 11,200 because we failed to record those fees earned. 1 and 3 both affect expenses and cause our expenses to be understated by the amount of the 2 added together, which is 10,300. Okay. Now, how do we determine what affects net income? All right, so we already talked about in A, when you understate revenue, okay, it's definitely going to understate your net income. If you understate expenses, you're going to overstate your income because expenses are subtracted out of revenue. So if you understate your expenses, you overstate your net income. If you understate your revenue, you understate your net income. Now, when you have this situation, they're wanting you to combine the two, okay, to determine if how these two, both understated revenues and understated expenses, how these two together affect net income. So in this situation, you take the total amount of expenses and subtract out the total amount of revenue, and you actually get a negative 900, meaning that your net income is going to be understated by $900. Okay, so the last problem we're going to look at, because I didn't want to get this video too long, so I want to go ahead and look at this last one. This is doing your vertical analysis. Okay, so the vertical analysis is comparing your operating expenses and your income from operations and comparing what percentage of those came from your fees earned. Okay, so right off the bat, you're going to enter 100% of behind your fees earned. Okay, this is your base. This is your base. All right. So what I mean by your base is this is what you are going to work off of. Okay, when vertically analyzing. Okay, these 2 years income statements. Okay, so this is why we call it a vertical analysis, because we're going to vertically analyze. So we want to know what percentage of revenue went to operating expenses and what percentage of revenue went to your overall income. Okay. So how do we come up with that? You start by taking this first one right here, 540,000, 540, and divide it by your total fees earned. Okay. And then to get the percentage, you just multiply it by 100, and that's going to tell us 78%. Okay. Do the same thing over here. We're going to take 481,340, divide it by fees earned, which is 587,000. Multiply that by 100, and that should give us 82%. Okay. All right, last, we're going to do it for the income for operations for both of these. So how much of the revenue generated the income from operations? So again, we're going to take that 152,460, divide it by 693,000. And multiply that by 100. We'll do it for the same one over here. 18%. All right. Now, so what this tells us is 78% of our revenues was used to pay operating expenses and our current year, and 82% of our revenue was used to pay operating expenses in our previous year. So then it asks us in B, does a vertical analysis indicate a favorable or unfavorable trend? So even though our expenses increased from one year to the next, so did our revenue. Okay, so did our revenue, which is why it's important to do this vertical analysis, because we can look to see that we only had to utilize 78% of our revenue in our current year versus the 82% that we utilized in our previous year. So I would consider this a favorable trend. So fingers crossed, check our work. Yay, all green checks. So but again, how we came up with these percentages is you always start out, you go ahead and just go ahead and enter 100% for your fees earned, because that is your base. And and then you're going to always take your operating expenses and divide it by your total fees earned, and that'll give you what percentage of your revenue went to expenses. And obviously we did a favorable trend because we utilized less revenue, and therefore we had we used less revenue for operating expenses, leaving more percentage of our revenue to go to our net income. Okay. So that is it for learning module 3, practice problems. Again, these are in Cengage. You are welcome to work these practice problems as many times as you need to until you feel very comfortable in figuring out the answers. And again, if you have any questions, you can feel free to email me. So good luck, guys.